Welcome to The Explainer. Today we're tackling a massive question. What really moves the trillions, yes, trillions with a T, of dollars in the foreign exchange market every single day? It's this gigantic, pulsating global network, and we're going to unpack exactly how it works, literally from the ground up.
To do this, we're going to start down at the absolute smallest mathematical unit of a single trade. Then we'll zoom out to the algorithms that execute these trades by the thousands. And finally, we'll look at the planetary scale forces driving the whole shebang. So what's really calling the shots out there? Is it the math, the machines, or the media?
Okay, here's our roadmap for the explainer today. First, pips and profit basics. Second, automated triangle hedging. And finally, news sentiment versus reality.
Let's dive right into Section 1, pips and profit basics. To really grasp the macro forces, we first have to ground ourselves in the micromechanics of how Forex profit is actually measured. Enter the pip. It stands for percentage in point, and it is the absolute smallest unit of price movement in the Forex market. For most currency pairs, it represents just 1/10,000th of a point. I mean, it's an almost imperceptibly tiny fraction, but as you'll see, it's the fundamental building block of all Forex wealth and loss.
Now, because a single pip is basically less than pocket lint, traders don't buy single units of currency. No way. Instead, they buy what are called lots. A standard Forex lot consists of 100,000 units of a base currency. And when you magnify a tiny fraction by 100,000, suddenly real, serious money is on the line.
So how does this actually translate into a trade methodology? Well, following FX Globe's breakdown, it's a pretty straightforward step-by-step process. You've got to know your base and quote currency, confirm your lot size, whether it's standard, mini, or micro, track that fractional pip movement, and then you just run the math.
And the absolutely crucial point here is this formula. According to FX Globe, if you trade a standard lot of the euro versus the US dollar at an exchange rate of 1.1301, a single pip movement equals exactly $10. Gain 50 pips, you make $500. Lose 50 pips, yeah, you're down $500. It is just cold, hard, granular math.
All right, moving on to Section 2, automated triangle hedging.
Now that we've got the math down, let's talk about the machines. The Forex market is ultra high frequency and it never sleeps. It runs 24 hours a day, literally chasing the sun across global market sessions, opening in New Zealand and cascading all the way to the United States. But since human traders actually need to sleep occasionally, they rely heavily on automated MetaTrader 4 expert advisors, basically custom-built robots designed to never miss a single tick.
What's really wild is the stark contrast you can see in this technical study by Universitas Taru Manegara. Look at the incredibly simple inputs a human gives the robot, just telling it, hey, watch this small moving average and this large moving average. But then look at the highly complex rapid-fire profit and loss ledger the robot automatically generates from that. The human sets a simple rule, and the machine turns it into an absolute flurry of mathematical execution.
You can actually see the algorithm at work here on the euro to Japanese yen pair. See those little red and blue markers? That is the robot executing buy and sell orders the exact millisecond a small moving average crosses a large moving average. There's no hesitation, no second guessing the morning news, just pure instant execution. But here's the kicker. It doesn't just trade one pair in a vacuum. As it opens positions on, say, the British pound to Japanese yen, the robot instantly calculates the remaining lots needed to perform what's called a triangle hedge across multiple pairs. It is constantly balancing its exposure, locking in a target profit of just $2 at a time. $2 over and over and over again.
The hidden logic behind this machine is just fascinating. The algorithm strictly follows the two cycles you see mapped out here. If it buys the euro against the yen, it simultaneously sells the pound against the yen and sells the euro against the pound. It essentially creates a perfectly closed loop to completely mitigate risk. No human emotion, no panic selling, just flawless mathematical architecture.
Which brings us to our final part, Section 3, news sentiment versus reality.
So, if robots are out there managing these mathematical pips at lightning speed, we really have to step back and ask, what macro forces are actually dictating the larger market trends these robots trade within? I mean, we naturally assume it's the talking heads on TV, right? Global headlines, political drama, surely that drives the market. Well, a seriously deep dive study published in the Athens Journal of Business and Economics offers a massive, almost unbelievable plot twist. To find the truth, researchers tested millions of data points. They used an advanced machine learning AI called BERT to read and score the sentiment of geopolitical news. Then they pitted those news sentiment scores directly against hard financial indicators, specifically the traded volume of crude oil and the forward interest rate differentials between countries. The data they found completely shatters a major illusion. For almost every single major currency pair, whether it's the US dollar to the Chinese yuan or the euro to the Russian ruble, news sentiment has absolutely zero significant explanatory power, none. The market is literally ignoring the headlines. The actual primary drivers, WTI and Brent oil futures, and the cost of money via forward rates.
Let's break down exactly what this means for us. News sentiment plays barely any role in exchange rates. The euro to US dollar pair is the only one showing even a weak sensitivity. And get this, strangely enough, positive news about the EU and US actually weakens the euro, likely because of complex trade dependencies. The real puppet masters moving the trillions of dollars, they aren't the politicians you see on the evening news. It's the planetary flow of crude oil volumes and the mathematical interest rate differentials set by central banks. The researchers came to a pretty stark conclusion. They stated point blank that news media simply fails to capture real financial developments. Why? Well, it could be due to systemic underreporting, or journalists may be misunderstanding complex geopolitics, or honestly, it might just be the sheer blistering speed at which algorithmic markets operate compared to the clunky human publishing cycle.
And that leaves us with a final, provocative thought to ponder. As we zoom out from the mathematical fraction of a single pip to the tireless hedging robots scanning moving averages, all the way to the massive planetary volumes of oil moving the needle, is human news becoming entirely obsolete in modern finance? If the machines are only listening to the math, maybe we should be too. Thanks for joining me on this explainer. I hope it gave you a completely new lens on how the world's largest market actually operates. Catch you next time.